US debt has grown to become 350% the size of the United States GDP. That means debt is 4.5 times larger than the size of the US economy. And the majority of this increase actually occurred between 1980 and the present day. We also witnessed such a steep increase leading up to the Great Depression. The unwind that you see here occurred during one of the largest and most traumatizing economic downturns in history, the Great Depression in the 1930s. Now, in 2008, we also witnessed a traumatizing financial crisis, but we haven't seen a big deleveraging event like we saw after the Great Depression, and that's leading many people to believe that the worst is still yet to come, and the risk of another financial crisis like we saw in 2008 are still very much present today. Clearly, this is not a scenario that the stock market, for example, seems to be very concerned about today. The stock market is inching back up towards its all-time high. Then again, in October of 2007, the stock market was making new all-time highs just a year before Lehman Brothers collapsed, triggering the financial crisis and the meltdown in the stock market. If the same thing were to happen today, it would look something like this. So it's a fair question to ask whether we see similar risks in the financial system today, especially when we know that the amount of debt that businesses owe in the United States is at a higher level than leading up to the 2008 financial crisis. This is actually a chart that tracks how much debt businesses have relative to the size of the economy, so that's GDP. Today, the total debt that US businesses have is equivalent to around 75% of GDP, up from around 50% back in the 1980s. So you can say that businesses in the United States are more leveraged today than at any point over the last 40 years, because debt is, at the end of the day, a form of leverage. Businesses take on debt today in order to increase their investments by spending money that they would have otherwise not had. The more they'll have to pay back in the future, and so the more vulnerable they are to defaulting. In 2008, the fuel that really triggered the financial crisis wasn't business debt, it was household debt. So the amount of debt that individuals had. Household debt relative to the size of the economy went up from 50% in the 1980s to almost 100% in 2008. So the amount of debt that individuals owed was the same size as the total size of the US economy. That was mainly fueled by people taking on debt to buy homes during the housing bubble, and the US banking system was very much exposed to all of this leverage. Many banks were highly levered, and when the housing market crashed, people began to default on their loans and the banking system crumbled. But since 2008, we've seen household debt come down pretty significantly. Of course, it is still very high by historical standards, but it does suggest that we've seen a deleveraging of households since 2008. People have actually been reducing their debt burdens. Businesses, on the other hand, have seen their debt burden rise substantially since the financial crisis. So are we about to see the same thing that happened to households in 2007 happen to business debt today? More debt isn't necessarily a bad thing if you actually are earning more. Debt only becomes a problem when businesses start to have a more difficult time actually paying it back. And this chart shows us exactly that. It tells us how difficult it is for businesses to pay back their debt. The lower this line is, the more difficult it is for businesses to pay back their debt. And today it's telling us that businesses are having a more difficult time repaying their debt than right before the 2020 recession and right before the 2008 financial crisis. So yes, businesses seem leveraged on debt and actually pretty vulnerable today, but they can't trigger a financial crisis just by themselves. The banking system in 2008 was ultimately what caused the financial crisis. Banks were over-leveraged, overexposed to bad debt, which led to a total collapse of the financial system as soon as people began to default on their loans. And today it actually seems that banks have learned their lesson from the financial crisis. This chart shows us how resilient banks are. The higher this line is, the more assets banks have to absorb losses. And the lower the line, the less resilient they are. Of course, heading into the financial crisis, this ratio was very low. Banks had almost no assets to absorb any losses. And so when households began to default on their debt and not pay back the banks, the banking system had no way to absorb those losses. Now, after the financial crisis, this story radically changed. Banks built up their balance sheets, increasing the amount of assets they had, and so increasing their capability to absorb losses. Now, this didn't happen because bankers all of a sudden developed a conscience. They were forced to take less risk by authorities. There was something called the Dodd-Frank Wall Street reforms, which increased the amount of oversight on banks, significantly limited the amount of risky lending that banks could do, and also made sure that banks couldn't own risky assets. So banks can't lend to risky companies or individuals like they did in 2007 anymore. So who is lending to them now? Because I can assure you, risky companies still exist. The number of zombie companies in the United States has risen substantially over the last couple of decades. These are unprofitable businesses that have a large amount of debt. So if it's not the banks, who is lending to these risky companies? Who is taking on this risk? That's where something called private credit comes in, or what some people call shadow banking. This is an industry that back in 2008 was less than 15% of the banking system, but shadow banking has now grown to become 50% of bank lending done to businesses in the United States. And you guessed it, shadow banking is not regulated by authorities. So yes, you heard me correctly. Ever since financial authorities began to regulate bank lending in 2008, we've seen a massive portion of bank lending get transferred to an industry where lending is not regulated. Shadow banks, which are usually hedge funds, fintech companies, or insurance companies, they can lend 6 times the amount the company borrowing is actually earns. That's the limit that's imposed on banks. These private credit firms can lend to high-risk borrowers, and they can keep their lending completely opaque, unlike banks that need to be transparent about what and who they're lending to. We know there are 9 of these firms that represent around 90% of the shadow banking industry. These are firms like Blackstone, Apollo, Ares. Together they manage around $1.2 trillion in assets, which is up from $700 billion in assets back in 2018. That was just 5 years ago. And back then, those 9 firms made up a much smaller portion of the industry. This is what's known as concentration risk. When just a handful of firms make up a massive industry, $1.5 trillion of wealth destruction could theoretically happen very quickly if the risky businesses that they've been lending to begin to default on their debt, just like risky individuals defaulted on their debt in 2007. Now, the counter argument against seeing this type of scenario happen is that these shadow banks actually have a lot less leverage than regular banks. Typically, the leverage ratio of a private credit firm is $1 of capital for $2 of debt. So they own around twice as much debt as they have assets to absorb. Now, that may sound like a lot, but banks often have leverage ratios of $1 of capital to $9 of debt. So regular banks, even though they are regulated, are extremely leveraged in nature, much more than private credit firms. It's just that they're a little bit less leveraged today than they were in 2007. Private credit firms, on the other hand, while they do lend to very over-leveraged businesses, they themselves are a lot less leveraged and could be more capable to actually absorb losses than banks were in 2007. There is also a key difference between how these private credit firms and how banks obtain their funding. Investors in private credit firms or shadow banks typically have their money locked in. They can't pull their money out overnight, and most of that money actually comes from state pension plans from California, New York, and Arizona. That is substantially different from banks that obtain their funding from people who deposit money at the bank. And these deposits are not locked in by any means. If everybody wants to withdraw their money from the bank at the same time, that's called a bank run, and it's caused many banks to fail in the past. And that's actually why authorities like the Federal Reserve and the FDIC actually provide money to banks when they're in trouble. That's not the case for the shadow banking system, which could actually be a big risk. In March of 2023, we saw a bunch of regional banks collapse. People thought this was going to be a repeat of the 2008 financial crisis, but the Federal Reserve stepped in to stop the panic. They provided around $100 billion in liquidity to these banks that were in trouble to avoid another financial crisis, which is something they also did back in 2008. But the shadow banking system, they're not official banks, so they wouldn't have access to that type of liquidity in the event that they fail. So unlike March of 2023, where the banking crisis led to absolutely no downside in the US stock market, a collapse of the shadow banking system could theoretically lead to a pretty large panic in the market and could actually be a root cause of the next financial crisis, because it does now represent around 50% of lending being done to businesses. These types of macro events can have a massive impact across across financial markets, leading to substantial volatility, that's the type of environment that we can look to take advantage of by being positioned correctly, something we help guide our clients through at Game of Trades. But unfortunately, we'll only really find out how vulnerable the shadow banking industry is in the next economic slowdown, because recessions are where over-leveraged parts of the financial system really get stress tested. In 1990, you didn't have any excesses in the system, so nothing broke, and the downturn actually ended up being quite shallow. In 2000, you had the dot-com bubble burst, with a huge number of over-leveraged tech companies going bust, triggering a big market crash and quite a severe recession. And in 2007, what could have been a shallow economic slowdown turned into one of the deepest economic downturns in history.